Wonderful good day, ladies and gentlemen. London Mines and Money 2014, and we are again here on the floor with the companies. And now we are at the booth of Condor Gold, and with me is a well-known guy called Mark Child, the CEO of the company. Mark, thanks for taking the time.
Pleasure.
You had some terrific news in the last weeks. You brought out a PEA and 2 PFS with nice scenarios. But before I dive into that, first of all, I want to ask you, is the company financed to go through the process?
Yes, well, we've just recently raised 6.4 million sterling, $10.5 million, so that funds us through on the base case in the pre-feasibility to bankable feasibility.
Yeah, fantastic, because these days it's important to have money because the markets are dried out.
That's correct, and half of that money came in from the World Bank, from the IFC. Which is a great vote of confidence to have the World Bank behind you. They visited site 3 times, and so they did a lot of due diligence. We're pleased with them as a shareholder.
Great. So let's dive into your news you had so far. You have a pre-feasibility study done, and also scenario A and B in a PEA
That's correct,
mode.
Yes.
So please, let's start with the PFS. What were the highlights?
Right. On the pre-feasibility study, we've done this. Although we're London listed, we've done it all to the Canadian 43101 standards. So we want to be understood in Canada and North America as well as London.
Who did it? This must be independent.
SRK Consulting have done it. So it's an independent study, and they're one of the top consultants in the business.
Absolutely.
So the pre-feasibility study is really done on a base case of the single open pit on La India. So La India open pit is 920,000 ounces of resource at 3 grams, and 840 of that was in the indicated ounces and 80 was inferred. Now you can only use indicated in a feasibility study, pre-feasibility or bankable. We've used that. We used 1,250 gold price. We've done the 12 studies that go into getting reserves, geotechnical, geochemistry, metallurgical, plant design, tailings, waste, infrastructure, resource. And that essentially gives us approximately 80,000 ounces a year of gold for a 7 or 8 year period on the base case out of a single pit. And that's reserves, and the reserve number is 675,000 ounces at 3 grams, so it's a high grade open pit. And grade is king, as people say in this business, so we're lucky in having that. That translates in economics to an operating cash cost of about $650 an ounce of gold.
It's quite low.
And assuming a contract mining scenario where we hire the trucks to move the dirt, which you do in this part of the world, in Mexico, because labor's cheap and they've got a good system. We've had independent quotes for that. And our all-in sustaining cash cost, which is everybody's looking at these days, is really what's the real cost of running the business, is just under $700 per ounce.
That's outstanding. Even with those gold prices, you would have a super healthy margin.
That's right. So current gold price at 1,200, we're making $500 an ounce cash flow on 80,000 ounces. That's $40 million free cash flow a year after you've paid your sustaining capital costs. So that's great. I mean, if gold goes down to 1,000, we're still in business. We make $300 an ounce.
Yeah, probably a lot of other companies would have given up 1,000.
Yes, so it's a highly attractive proposition. What we tried to, the other point on the pre-feasibility is that we have low upfront capital cost. So our capital cost is about $110 million US dollars.
That's manageable.
And that would be, from the moment we decide to build the plant, it includes some pre-stripping, it includes land, it includes the plant itself, EPCM on the plant, all the infrastructure. So $110 million will get you pouring gold at 80,000 ounces of gold a year at 700 all-in sustaining cash costs. The payback on that capital in the pre-feasibility study is 3.8 years. So quick payback.
Fantastic,
But of course, 675,000 ounces of gold as a reserve is a relatively small number out of our resource. We've got 2.4 million ounces, so we've got a much bigger project here. But what we decided to do 18 months ago when we saw the market coming down, we had 2.5 million ounces of gold. The message was prove it's economic. There's no people have made mistakes in this business by chasing ounces. We could add another 1 million ounces of gold. No one really cares. The question is, have we got economic ounces? And that's what we proved with this study out 2 weeks ago.
Absolutely. I think that's also the scenario A and B. What you have done, let's say for the brighter,
Yes.
longer future, I would call it, which is also including an underground scenario. Am I right? And so maybe elaborate a little bit on that too.
Okay, thank you. What we've tried to do, in addition to the reserve case and the feasibility, we've tried to show the upside of the project on some of the existing ounces, important to say. So if we add in the feeder pits, we get up to 100,000 ounces a year for 8 years.
How much more does it cost when you make the large scenario?
Not too much. It costs another $17 million, so it's $127 million. But most importantly, our payback remains under 4 years. Our all-in sustaining cash costs remain under $700 an ounce. So
again,
yes. So what we do is you can add in 25% more production from 80 to 100. But your CAPEX is only about 12% more. So economically, it makes sense. You get some economies of scale of just running a bigger operation. Your G&A doesn't really change.
For that you don't need a larger management, that's for
right.
sure.
And so that's PEA 1 scenario, that's all open pit, I should just emphasize. We've done another scenario which we wouldn't do, but we want to remind people we have, it might be somebody else wants to do it, but the other scenario is adding in underground production. So on only the main 2 veins, La India and America, underground production would be, over the life of mine, would be about 480,000 ounces produced, and that's quite high grade. It's higher grade than the open pit. It's 5-6 gram material underground with a 2.5 cut-off grade. So our cut-off grade goes up when we do underground, and that gives you 140,000 ounce production. So what we're showing the market, our shareholders and the trade and everybody else, is we've got a very economically viable project. We can ourselves, we think, put in the base case of 80,000 ounces around. It's low cash cost. We can EPCM it. Someone else can do it for us.
Especially with a partner like IFC. That could be somebody who says, "Hey, why not? I'm stepping in. I bring some partners with me."
That's right. Well, the IFC would like to. Are in there for the long run. The IFC want to see a mine go up here. They've made it quite clear to us. The head of global mining is here at the Mines and Money conference, and they're there for the next equity round. Should we need that? They'd like to lead the bank debt. We'll have to see whether they do, but they're a new shareholder. They have a right to someone on the board. We think it de-risks, and they also act as a form of political insurance as well. When you're dealing in an emerging market, they have 30 40 people in Managua. They can talk direct to the top. So you're right. They want to be there and they want to see a mine up.
So you're in pretty good shape.
Yes, we are. It's just a little depressing that when you do all this hard work and you've probably got one of the best exploration assets on the London stock market, 2.5 million ounces at 4 grams, very economic, low payback, that your shares go down when you announce a pre-feasibility.
It's totally crazy, but that's a stupid market we have so far.
But it'll turn at some stage, and when they do come in, this is a sort of company that people will be targeting. It'll just go up very quickly, I think.
Fantastic. Mark, all the best on that.
Thank you.
And I'm sure you get it done because you are that far and the economics are brilliant.
Yes.
So looks like we're getting a new mine in Nicaragua soon.
Yes, we will do. We'll fast track it to production whichever way. The next steps really are de-risking the project from a land acquisition, permitting, environmental permits. So we've proved it's economic. We're now going to work with the government to tick the boxes now, permitting land, those sort of issues, which we don't see a problem. I've hired human rights lawyers working full time for us, environmentalists. We've got a team of 6 working on that strategy. And that again makes it really, really attractive. I had dinner with the government 10 days ago. This Saturday I fly back out to Nicaragua, so I'm only back for 2 weeks. I'm spending quite a lot of time out there just making this happen.
Yeah, great. Last question, what would be the time frame until you're then in production? What do you think?
I think we need
another possible time frame.
Yeah, we need another 12 months of to get to bankable feasibility and to get all the permitting. And I'd like to think that we're having a conversation in 12 months' time where we've made major steps with that. The build, according to Lycopodium, who build 3 gold mines a year on average, an Australian listed company, they can build this in 18 months. Super. So assuming we got the permits and so forth, then we could, in terms of pouring gold, you're probably 2.5 years away from today.
Fantastic. So that's 2017, something like that.
First quarter, say, around about that.
Well, that's not that far away, I would say.
It's not a big mine to put up. So,
Great. Super.
Okay.
Merry Christmas. Thank you very much,
Thank
Mark.
you. Thank you for your time again.
Ladies and gentlemen, it was Mark Child, the CEO of Condor Gold. Well, you heard it. Fantastic scenarios, fantastic all-in sustaining costs. It doesn't matter if they do the open pit scenario or if they would include an underground. It's all the time below the $700 level. So above, let's say, $700 gold, this company will make money in the future. And also the CAPEX is between 110 million going up to approximately 167 million. So it's all manageable, and the IFC is on board. That's a strong commitment, and a strong commitment to the management and for the company. Thanks. Bye-bye from London. Merry Christmas.